Up 2.5. Tesla's been a tough stock of late, but it's getting a nice boost as well. It does take us to our talk of the tape, how best to navigate what could be a more volatile market ahead. And let's ask our panel. Adam Parker, he is the founder and CEO of Trivariate Research, and a CNBC contributor. Bryn Talkington of Requisite Capital, also a contributor for CNBC. And Chris Harvey, the head of equity strategy at Wells Fargo Securities. No contributor for you, but you know what? There's always a chance someday down the road.
One day.
It's good to have you nonetheless. I'll give it to you first, Harvey. This market pretty resilient, don't you think?
It is, right? And it's going to stay resilient until we see some sort of crack up or some sort of liquidity event in the credit markets. Credit markets are supplying a ton. It's something that people don't look at, but underlying everything, a ton of liquidity. That's keeping volatility low. The system's working really well. And any sort of volatility spike, I think, will be short-lived in the first half of the year.
So we're underestimating or not the risks that could be out there. Do you think we are? I mean, Larry Summers, the former Treasury Secretary, posted on social media, we're now, I'm quoting from his thing, we're now in the riskiest period for inflation policy since the early Biden administration. That's following today's CPI. Ken Griffin yesterday at a conference down in Florida talks about the rhetoric from the White House about tariffs, which he calls, these are his words, bombastic. He says the damage has already been done. It's a huge mistake to resort to that form of rhetoric as it pertains to trading partners. What do we think? Does any of that matter, or is it just noise?
I think it matters. You know, our call for the first half of this year was the market would be lower, choppy and lower. It's the first time we've had sort of a negative view in a long time. And two of the reasons you just highlighted there. One is I think we're closer to the end of dreaming that the accommodation is bullish for equities. Just like at the end of 22, people said, you know what, we've been hiking a lot. We're close to the end of the hiking cycle. We can get bullish again. It feels like we're getting close to the other side of that, or it's harder to dream that the Fed's going to be a huge tailwind on the front end. And the second thing is it's hard to know what policy to listen to and what not, and what it does to the earnings of companies. If you're the CEO of a big company and you have employees and customers in certain other parts of the world, I think you're a little bit worried about how to price your product and the like. So I think we're in a bit of a volatile spot. I do.
But it was right to be bearish when we were at the beginning of a hiking cycle.
Right.
Why is it right to be bearish if we're at the end of the cutting cycle? That means that we're good, that we're getting back to normal, that earnings are good, and the economy's good enough. What's wrong with that? Harvey's shaking. He agrees with me. Look at him.
All right, well,
sounds good to me.
Believe me, ask him.
As usual, you find somebody to beat up on me. No, I mean, and Bryn, you'll follow and you'll talk some sense into these guys. So, to me, I think, look, you don't fight the Fed at the beginning of the cycle because you don't know when the accommodation is going to end. At some point where you're closer to the end of cutting, you can't say, oh, I also have this Fed tailwind. So I think the challenge would be if you get a couple of hot CPIs, they're going to cut less than you thought. It's not as bullish for the multiple as it was before. I think historically there's been a pretty strong relationship between the change in perception about rates and the change in multiples for growth stocks. So I don't think it's like a disaster. But what you're saying is they stopped because growth's going to be awesome. Or not you're saying, but that's implied. So I think that's what we need to believe. And a lot of our stock selection stuff is around where is revenue accelerating, because I need to believe I'm going to get accelerating revenue.
I hear you. I mean, I guess, Bryn, part of my point, Bryn, is like, all right, enough of the multiple expansion. Great, we got it. We know why we got it. Now we actually can stand on the back of earnings. And that's all that matters. That's why the market's been resilient. That's why it hasn't fallen fully out of bed over tariff talk and a CPI today that was hotter and rates are up a bit.
So we're looking for, let's separate the 7 companies from the 493. And if this comes to fruition, the 493 are expected to grow earnings at 9% for 2025 versus, I think it was around 1 to 3% last year, while the Mag 7 is decelerating from the mid-30s to the 16. And if you actually even peel that back, it's mostly Meta and NVIDIA of the 7 that are growing earnings. And so I think that we're set up this year for broader participation because to earnings growth, you're getting a much bigger effect from 24 to 25 from the rest of the market, while Mag 7 is decelerating. But also, if you look at history and look at rolling 3-year returns, so unlike the Kansas City Chiefs, who couldn't do a three-peat, the market actually, on a rolling 3-year return, goes up about 80% of the time. But it's very, very, very rare. It happened in the 60s and the 90s when that third year had a 20 handle on it. And so I think that you definitely have a tougher sledding this year because of all of these dynamics. And I think that look for earnings, look for broadening out. But I do think it's a really positive sign that we saw the market completely shrug off the CPI number, especially in some of the higher beta names like that I follow and own, like the Palantir, the Hoods. Look at Uber today with an 8 handle. So I think this is a really positive sign, I'll say, for animal spirits, that we could shrug off today's CPI, which I thought was somewhat jarring.